Hello, brothers and sisters. A warm welcome to Investigate. I'm Avatar Lahiru, your guide in this series. Nice to see you again. Today, we cover the third substantive topic of Chapter 3, Managing Investments. After learning how to save, the next step is learning how to invest. Savings keep your money safe, but investments make your money grow. This is a special episode to Investigate because our channel is dedicated to educating and exploring ideas, values, and principles about investing. However, note that learning how to investigate to invest is an advanced undertaking, requires patience and long-term study and dedicated practice. Therefore, the content herein provides a simple and general picture of investing suitable for the audience of this series on financial literacy. Yet this video is the longest in the series. I hope you will bear with me and listen carefully, as this is going to be invaluable in your quest for long-term financial well-being. So with that in mind, what is an investment? The central bank defines investment as the act of committing money or resources today with the expectation of generating income or profit in the future. In simple words, investing means putting your money to work so that it grows and creates wealth over time. So, why is investing important? The Central Bank of Sri Lanka highlights several important reasons why investing matters. First, investing helps with building wealth. Over time, smart investments allow your money to grow and steadily increase your net worth. Second, investing is key to achieving financial goals. It makes it possible to finance the big things in life: buying a home, funding education, purchasing a vehicle, or retiring with comfort and dignity. Third, investing helps with defeating inflation. As prices rise, the value of money falls. If your savings just sit idle, they lose value year after year. A good investment protects your purchasing power and ensures that your hard-earned money continues to hold and even increase its value. So what can you invest in? In Sri Lanka, there are several popular investment opportunities. First, you can invest in shares. By buying shares through the Colombo Stock Exchange, you become a part owner of a company. If the company grows, share prices rise, and you may earn dividends or capital gains. Second, there are corporate debt securities, bonds or debentures issued by companies. These provide fixed income, but the level of risk depends on the company's financial strength. Third, you can invest in treasury bills and treasury bonds issued by the government of Sri Lanka. These are considered very safe investments with guaranteed repayment, although returns are moderate. Fourth, you have mutual funds and unit trusts. Here, your money is pooled together with other investors and managed by professionals who invest in shares, bonds, or other assets on your behalf. Fifth, there is real estate. Buying land, houses, or apartments can bring steady rental income or capital gains when property values rise. Sixth, you can turn to valuables such as gold and silver. These precious metals are traditional investments and are often used as a hedge against inflation. Seventh, you can invest in businesses. Whether it's your own venture or someone else's, returns come in the form of profits. And eighth, there is insurance with investment value. These are specially designed packages that combine protection with a payout at maturity, often higher than your total contributions. Now, let us look at factors to consider before investing. When you invest, there are several key factors you must always consider. First, the objective of the investment. Every investment should aim at a financial goal, whether it's generating income, preserving wealth, accumulating capital for future needs, or achieving long-term objectives like retirement or education funding. Second, the return from the investment. Return is the total gain or loss, which includes both income, such as dividends or interest, and capital gains or losses from changes in value. Third, the return frequency. This refers to how often you receive returns, daily, monthly, quarterly, or annually. It's important for managing cash flow and planning a balanced portfolio. Fourth, the risk and safety of the investment. Risk is the chance of losing money or seeing volatile returns. It depends on the stability of the issuer, market conditions, and the type of asset. Discussed more fully below. Fifth, the maturity period. This is the lifespan of an investment, the time until your principal is repaid. Shorter maturities mean faster access to your money, while longer maturities often carry more risk and less liquidity. Sixth, the tax impact. Taxes reduce your net returns, so it's important to understand how your investment is taxed under local laws before deciding. And seventh, the liquidity of the investment. Liquidity is how quickly and easily you can convert your asset into cash without losing value, while illiquid ones may take time and could sell for less than market value. When you invest, it's important to understand three key ideas: risk, diversification, and the time value of money. First, Risk is defined as the chance that an investment's actual return will be different from what you expect, including the possibility of losing money. For example, government bonds are considered very safe, but they usually provide only moderate returns. Shares, on the other hand, can deliver high returns, but their prices can also fall sharply. This is where diversification comes in. Diversification is defined spreading your money across different types of investments so that losses in one area can be balanced by gains in another. Instead of putting all your money into one investment, spread it across different types of assets. That way, if one loses value, the others can help balance the loss and protect your overall wealth. Diversification doesn't eliminate risk, but it makes it more manageable. Now, the time value of money, or TVM, is one of the most powerful ideas in personal finance. In simple words, a rupee today is worth more than a rupee tomorrow because today's rupee can be invested to earn returns. This concept is the foundation of almost every financial decision you will ever make. Let's break it down step by exploring the key composite ideas behind TVM. 1. Present value. 2. Future value. 3. Discount rate. 4. Compounding interest. 5. Compounding frequency. First, there's the idea of present value. That's simply the value of money today, right now. Then comes future value, the amount your money will grow into in the future, depending on the return you earn. For example, if you invest 100,000 rupees today at 20% interest, in 1 year it becomes 120,000 rupees. Now, let us look at the discount rate. The discount rate is the return you expect to earn on your money if you had it today. It's like the cost of waiting. For example, imagine that someone offers you 11,000 rupees 1 year from now, or 10,000 rupees right now. So, the question is whether 10,000 rupees invested today is worth more than 11,000 rupees in 1 year. If you get 12% return after 1 year on 10,000 rupees invested today, then in 1 year the total is 11,200 rupees. This is more than 11,000 rupees you could receive waiting 1 year. So the cost of waiting is not justified, as 10,000 rupees invested today is worth more than 11,000 rupees in 1 year. Next, there's compounding frequency, how often interest is added to your investment. The more often it compounds, monthly, quarterly, annually, the faster your money grows. This leads to compound interest earned not just on your original investment, but also on the interest that has already accumulated. For example, if you put 1,000 rupees in a savings account at 8%, at the end of year 1, you'll have 1,080 rupees. At the end of year 2, you'll have 1,166 rupees. Notice it's slightly higher because now you're earning interest on interest. Remember, we can't forget inflation. Inflation eats away at the value of money over time. If your money just sits idle, it loses purchasing power. To grow in real terms, your investments need to give returns higher than inflation. So where do we actually see the time value of money in our daily lives? In saving and investing. The earlier you start, the more time compounding has to work its magic. A small amount set aside today can grow into something much bigger tomorrow. In debt management, the faster you pay off debt, the less interest you'll pay over time. Waiting means more compounding against you and more money lost to the lender. In retirement planning, even small consistent contributions can grow into a large fund over decades, but only if your returns outpace inflation. Otherwise, the value of your savings shrinks over time. The central bank's curriculum highlights 7 golden tips for choosing the right investment. First, choose investments that match your financial goals. If your goal is short-term, pick liquid options like fixed deposits. For long-term goals, look for higher return investments. Second, do thorough due diligence. Research the company's financial strength, stability, and reputation before investing your money. Third, evaluate creditworthiness. For debt instruments like bonds, check ratings from agencies such as Fitch or S&P to understand the risk. Fourth, check the collateral. Secured investments backed by assets give extra safety in case of default. Fifth, verify regulatory compliance. Make sure the company is properly registered with regulators such as the SEC, CSE, or the Central Bank of Sri Lanka. Sixth, beware of unrealistic returns. If an investment promises extremely high profits with little or no risk, it's likely a scam. And seventh, seek professional advice. Certified financial advisors can help align your investments with your goals and risk profile. Please note that the CBLS curriculum has provided further information on the procedures and advice on how to invest in shares of companies listed in the Colombo Stock Exchange on pages 45 to 47. Similarly, the curriculum provides information and advice on investing in debt securities on pages 47 to 49. Investigate will publish its own series on these topics with insights from industry experts and practicing investors. Therefore, we will not explore these topics here, but stay tuned for our own series on these fundamental topics. Since we already know why does this matter to us, I will not repeat that question here again. Please re-watch this video and understand it as best as you can. In the next video, we'll explore how to take that control further by learning about managing debt, a force that can cripple you or give you a boost. Thank you for listening. See you in the next video.